All right, good afternoon, ladies and gentlemen. Must be some very good coffee out there, but I'm hopefully a few more people drift in. Um, Great to be here in Dubai, and thanks, Kevin and Mia, for the invite and the whole Marine Money team. Um, my name is Thom Payne. I'm a director at Westwood Global Energy, and we are a provider of market intelligence and commercial advisory services to the global oil and gas sector. So today, I have the good honor to talk to you guys about our current thoughts about offshore oil and gas markets and how that is going to impact demand for drilling rigs, but also the offshore marine fleet. So this is effectively all the vessels involved in the upstream extraction of oil and gas, but primarily the support vessel fleet, the platform support vessels, and the anchor handlers. So getting straight into it, I thought it probably makes sense to have a bit of a recap of last year. And when we think about 2024 for upstream oil and gas, it was certainly a year that's going to go in the records as a very positive year, a very good year. This first chart that we have on the left is plotting the supply-demand balance for the global crude market. So these gray bars is effectively the oversupply or the undersupply of global oil, and then the blue line is Brent spot prices. Now, typically, when we're within 1 million barrels of undersupply or oversupply, we consider the market to be balanced. And when we have a balanced market, we typically have a robust oil price. And you can see that over the course of 2024, we had an average Brent spot price of just north of $80 a barrel, which in our view and the consensus view is very much conducive to increased levels of investment in oil and gas activity. So that's new projects and new investments and new infrastructure. So fundamentally a positive year there. That translated, of course, into increased levels of expenditure, which is shown on the second chart, which is offshore EPCI investment. So this is all the spend by oil companies on new infrastructure for production. And you can see that 2024, whilst not eclipsing what we saw in 2022, bearing in mind that 2022 saw a lot of catch up from deferred projects during COVID, it was a very, very robust year. We saw a huge amount of investment into new fields, new developments, new floating production systems, production platforms, etc. Last chart here is looking at rig counts, and this is where we start to talk around 2024 maybe being a year of two halves. Every year has two halves, of course, but different narratives within those two halves. Certainly, we saw an increase in those rig counts, as you can see in the grey line there, but as we kind of moved forward into 2024, we started to see something of a weakness in the rig market. Now, a lot of that can be attributed to Saudi Aramco's decision to suspend 33 jackups, which came, of course, as a reaction to the oil ministry deciding to maintain its MSC at 12 million barrels a day, which was a decision that kind of shocked the sector to some degree. We certainly had a lot of phone calls about it. But that did have this impact of reducing the contracted rig count globally, maybe most notably felt in this region, although it does remain relatively robust. Today, of those 33 rigs, just over half of them have already found work. So while there is a bit of slack in the market, it certainly created a little bit of oversupply that we weren't anticipating. So that's kind of how 2024 played out at a very high level. So if we think around 2025 and some of the headwinds that are going to carry on from last year. Now, when we talk about headwinds in any industry now, obviously everything is being overshadowed by tariffs, and that is all everyone wants to talk about today. How are you factoring in tariffs? How are tariffs impacting everything? The reality is it's too soon. We don't know. Every day it's changing. It's not going to be good. But the impact of how bad it might be is really going to be a case of when the dust settles and we start to see some of the data creep through. So when we're talking here, we haven't necessarily factored in the tariffs, but of course, pinch of salt, things could get worse than this. The risk is very much to the downside. Now, when we think about some of the macroeconomic headwinds in the oil and gas sector, one of the key fundamental issues is Chinese oil demand. So this first chart is plotting Chinese crude imports on a monthly basis, and we also have the trailing 12-month trend line, and you can see that as we moved around halfway through 2024, we started to see this fundamental structural softening of Chinese crude imports. And this was a function not just of the increased sale of electric vehicles, but also of the faster than expected shift to LNG fuel for trucking, which is effectively seeing diesel demand in China now peak. The softening of Chinese demand has led to constant revision downwards of expectations for global oil demand in 24-25. The middle chart is showing the IEA and OPEC's view on 2025 oil demand globally and how that's changed over time. So taking OPEC in those blue lines, that dotted line at the top was the outlook for May 24. And by the time we got to January 25, you can see that they'd reduced their 2025 expectation by 1 million barrels a day, which is pretty significant. So what does this mean? It means we're heading into 2025 with a softer than expected oil demand scenario. But of course, to really understand how that impacts prices, we need to know the supply side. And when we look at the Brent price that I showed on the previous slide at around $80 a barrel, that's been made possible by and large by OPEC Plus intervention. So this is the OPEC Plus block taking barrels out of the market to maintain balance and to keep prices robust so that we can continue to invest. Since January 2023, the OPEC Plus block has taken out an additional 2.2 million barrels of supply, which are called voluntary cuts. It's over and above the standard quotas. And that's demonstrated by those negative green bars there. These are relative to January 2023, the amount of oil production OPEC Plus has taken out of the market. But what's very apparent is for every barrel that the group has taken out, the international market has put an extra barrel in. And that's shown by the positive bars here, where we have US liquids, Iran, Guyana, and Brazil, which are the biggest contributors to net increases in supply. So if every barrel OPEC takes out, 1 barrel goes in. And it's really created this tit for tat, which fundamentally to date has kept Brent relatively stable, excluding what happened recently with the tariffs where it dipped below $60. But again, this whole different presentation to talk about that. But what we have seen, if you look at the orange Brent price here, is that since the middle of last year, it started to trend downwards also gradually. So from around kind of an $80 mark, we've gone to a structural $70 to $75 a barrel mark. So our view for oil prices going forward, again, looking at market fundamentals and how they may prevail, is that we continue to expect prices to trend in this, broadly speaking, in this $70 a barrel range, which we continue to think is conducive of new investment into new projects. The hypothesis fundamentally being that if we do see shocks on the demand side, the OPEC Plus block will react and continue its intervention strategy. They are supposed to start to roll back the 2.2 million barrels in April. Last month, they cut 100,000 barrels a day. I'm sure there are ongoing discussions around the potential to defer rolling back those production cuts should demand soften due to any impact from tariffs. We expect the oil price to trend around $70 to $75 a barrel, but the risk is all to the downside right now with tariffs. We're also all waiting to see how the dust settles, what the impact on consumer demand data is going to be, but certainly in the short term, we certainly expect prices to potentially start to trade under $70 a barrel for at least the next couple of quarters until we figure out exactly where we are. So what does this mean for spending offshore? Levels of activity that drive offshore marine activity globally. So here again, you've got the offshore EPCI spending outlook, and you have that split by major regions. And you can see that we expect, based on visible projects, for the level of current spending to be sustained over the next few years. And the key contributors to this spend have been the Middle East and Latin America. They will continue to be major spenders over the next couple of years, but also Asia Pacific starting to contribute more as well. When we think about the volume of new infrastructure that's going to be installed over the couple of years, and this is the fundamental driver for the offshore marine fleet. Again, what we've kind of done is, I guess, the shopping list. When we look at floating production systems associated with deep waters, we expect 35 new units to be installed over 25 to 27, 15 of those in Latin America. We expect 311 fixed facilities to be installed globally, the vast majority in this part of the world, in this market in GCC, and just shy of 12,000 kilometers of pipeline. And again, the Middle East being the major contributor there. And if we drill down into the GCC market, again, of course, in this period of uncertainty where the Middle East has been such a driver of global growth in offshore marine, how robust is forward-looking demand? The chart on the right is showing the levels of offshore EPCI investment bunched into 5-year intervals. And what we've seen over the past 5 years is almost unprecedented spend in new offshore infrastructure. We don't expect for that level of spend to be continued in the next 5 years, although there will be some more greenfield projects to be sanctioned in our view. But what this means is all the investment that we've seen over the last 5 years, that offshore work has to happen over the next several years, which drives the activity for the offshore fleet. And these numbers are quite hard to read, but fundamentally what we're saying here is that the population of offshore production platforms is going to grow by around 36% between now and 2030. There will be 36% more offshore production facilities across the Arab Gulf between now and 2030. And the majority of those have already been sanctioned, are already being built, and will have to be installed as well. So the downside risk is relatively minimal in this part of the world. Looking at the offshore rig market, again, a major proxy, we already talked around the global rig count kind of softening as we moved into the tail end of 2024, and we talked around the suspensions from Aramco being a key part of that. But what we're going to see across the board for all offshore major rig types is we are going to see this softening in contracted counts in 2025. We talked about why that is the case for jackups. In the drill ship side of things, we have seen project deferrals and deferred exploration campaigns. If anything, that's going to be exacerbated by tariffs as well, as people start to consider guidance for 25 and 26. But what's important as well is we think fundamentally the supply-demand balance remains robust, and we think that after a dip in 25, we will see a return to growth across jackups and drill ships and even the semi-sub market as well, with the drill ship market exceeding 23-24 level to 86 units. So whilst we do expect a slightly softer 25, we do expect the rebound in 26 based on visible drilling campaigns. Key point to make out when we talk about offshore is pricing. The last few years have seen phenomenal increases in pricing across the board for goods and services, for equipment, for oilfield services, for rigs and for vessels. Day rates have been performing extremely well. But what's important to bear in mind here is if we are expecting a structural oil price of $70 or $75 a barrel, that impacts the cash flow for the end customer. We can't have a situation where we expect to see the same kind of day rate sustained as what we saw in 2012, 2014, where we had oil prices around $120, $130 a barrel structurally. We cannot expect to have the same level of day rate today when the oil price is $70 a barrel. Somebody has to pay for that pricing. So whilst we have seen very strong day rate performance, we do expect to see major pushback over the next rounds of negotiations with E&P customers. We do expect to see some softening and some potential dipping of rates across the board for boats and for rigs in many markets. There is, of course, nuance to that. And when we look at the OSV market, again, those last two charts shows the anchor handler day rates on a dollar per brake horsepower basis and the PSV day rates on a dollar per meter square of deck basis. And you can see the rapid ascension in rates, almost 100, 150% growth over the past 18 to 24 months. But as we moved into last year, that started to plateau, and now we are starting to see it soften for maybe term contracting. Of course, when we look at the level of construction activity happening in the Arab Gulf and the shortages and high utilization, we certainly expect rates to be very high and even to grow for the shorter term EPCI related work. We think that's already happening, but structurally we do expect some softening in the day rates. And that comes as many of the leading contractors are now reporting slightly softening utilization levels as well. So when we talk about the OSV fleet and some of the fundamentals there, of course, one of the key factors for the price, for the day rates increasing so much was the tightening supply and increasing utilization rates. Of course, that's always a driver fundamentally for day rates. When we look at the fleet, now, of course, that has been characterized by massive amounts of stacking from 2016 when the market dipped. And since then, as oil prices have fundamentally improved, with the exception of the COVID period, we have seen that laid-up fleet, which is that first chart there, be eroded as vessels are either scrapped or brought back into service. So what the second chart is doing here is showing the cumulative fleet change. This is the active fleet change since 2015. And of course, we obviously had a situation where the fleet grew as we saw massive amounts of deliveries in 15, 16, 17. We had a reaction with regards to scrapping, finally came around en masse from around 2017, led by Tidewater fundamentally. And since then, we have seen the total fleet continue to decline and balance and rationalize the market. But since the end of 2022, we have now seen that reverse. We've seen scrapping come to almost negligible levels right now. We have scrapped really what we need to scrap fundamentally. And we are starting to see a slow and steady level of deliveries. We're not seeing the same level of orders, of course, as we saw in previous upcycles, and we don't expect to see that. But we are seeing more purpose-led deliveries, which has led that orange line, which is a cumulative fleet change, to continue to increase. Just looking regionally at the GCC market, there's a lot happening here. I think you guys get these slides so you can kind of interrogate it on your own time. But what this is doing is showing the regional fleet changes by asset type. So we track every single vessel in offshore energy, where it is and what it's doing. And you can see that regionally there's a significant discord between utilizations that are being recorded, with the GTC certainly leading the charge with the highest levels of recorded utilization at around 84% in total, which of course is very high. 90% is effectively sold out. And then we have other markets, for example, parts of Southeast Asia where utilizations are much lower, at around 69%. And we have West Africa, which had started strong, but has started to soften and is currently around 75%. Second chart here is showing monthly working days for the OSV fleet across the Arab Gulf. And one of the key things to account for here is when we had that announcement of the rig suspensions, there was a lot of concern around, what's going to happen to the vessel market? Are we going to see a similar decrease in the number of working boats? And whilst we saw some softening in the first and second quarters of 2024, as you can see here, realistically, these boats went straight back to work. There was enough work in other markets, even in KSA, but also in the UAE and Qatar. We simply had enough work to absorb the impact of the rig suspension. It just shows really a case in point of how buoyant and robust activity levels are here in the Arab Gulf. And then my final slide here, it's conscious of time, is a kind of a sneak peek of what we expect to happen for supply and demand for the next few years. We've talked around all the fundamentals. You can see the blue bars on this first chart, which plot global demand for OSVs, which of course is a good indicator for regional markets. You can see that slight softening in 2025 because of what we've talked about in the rig markets. But post that, we expect to see year-on-year growth as the rig market recovers, but we also see new production facilities installed that require ongoing maintenance. And that will drive utilization to continue to increase in the 26-27 period, and probably beyond that for several years as well. And the last part I will talk about here is one of the nuances, of course, is we grow the demand, but of course every year what's true is that the fleet continues to age, and we're really hitting an inflection point because we build in cycles in all shipping markets, but in offshore as well. When things get old, they all get old at the same time. And what we're really seeing in that dark gray area, which is the supply of vessels which are aged less than 15 years, which had been a term limit for some operators, but maybe not the case now, we can see that really falling off a cliff as we move into 2025 and beyond. And the proportion of the fleet aged under 15 years, as you can see on the second chart, well, that's going to shrink from around 65% today to under 30%, around 25% over the next few years, which is quite a staggering transformation in the fleet. Of course, this now suggests new building. When's it going to happen? How are we going to do it? But that's a presentation for another time. So with that, I'll leave you guys and look forward to any questions afterwards. Thank you.